Imagine standing on the trading floor on March 10, 2000. The NASDAQ hits an all-time high of 5,048.62 points. Trillions of dollars flow into internet stocks. Entrepreneurs become overnight billionaires on paper. The world believes the internet will make everyone rich forever. But in just over 2 years, that same index crashes 78%, wiping out $5 trillion in wealth and destroying countless companies. This was the dot-com bubble, the greatest internet gold rush in history, and the explosion that followed. The dot-com era didn't appear out of nowhere. It built on decades of technological progress and a perfect economic storm in the 1990s. After the Cold War ended, the U.S. enjoyed prolonged expansion. Inflation stayed low, unemployment fell below 4% by 2000, and productivity surged thanks to computers and early networks. The real spark came from the internet's commercialization, originally developed by the U.S. military and academics as ARPANET in the 1960s. It remained niche until the 1990s. In 1991, Tim Berners-Lee invented the World Wide Web. Then, in 1993, Mosaic, the first user-friendly browser, made the web accessible to everyday people. By 1994, household computer ownership jumped from 15% in 1992 over 35%. Netscape's browser launched in 1994, and its IPO the next year would change everything. The Federal Reserve, under Alan Greenspan, kept interest rates low after crises like the 1997 Asian financial meltdown and 1998 LTCM collapse. Cheap money flooded markets. Venture capital, which totaled just $7.6 billion in 1995, began rising as investors hunted the next Microsoft. Key characters emerged. Jeff Bezos founded Amazon in 1994 as an online bookstore. Pierre Omidyar launched eBay in 1995. Jerry Yang and David Filo started Yahoo in 1994. These pioneers saw the web as a revolutionary platform for commerce, information, and connection. Adding .com to a company name became a shortcut to hype. Traditional firms rebranded online. The stage was set for explosive growth. The boom ignited on August 9, 1995, when Netscape went public. Shares priced at $28 doubled to $58 on opening, closing at $75. The 22-month-old company, with little revenue and no profits, reached a $2.9 billion valuation. This Netscape moment proved investors would pay premiums for internet exposure. The NASDAQ, starting around 751 in early 1995, climbed steadily. By 1996, it crossed 1,000. In 1997, it rose 33%. 1998 brought 28% gains despite global turmoil. Then 1999 delivered an astonishing 86% surge. From 1995 to 2000, the index rose over 600%, hitting 5,000. Venture capital exploded, $7.6 billion and $199,520 billion by 1998, peaking at over $100 billion in 2000. IPOs flooded markets. In 1999 alone, 457 companies went public, most internet-related. Many doubled or tripled on day one. Valuations defied gravity. Traditional metrics like price-to-earnings ratios were ignored. Instead, investors focused on eyeballs, user traffic, and network effects. The mantra, get big, fast. Companies burned cash on marketing to dominate markets before competitors. Super Bowl ads became .com battlegrounds. In 2017, internet companies spent $2.2 million per 30-second spot. Pets.com's single quotes as sock puppet mascot became iconic. Media fueled the fire. CNBC ran constant coverage. Magazines like Wired and Red Herring celebrated young founders. Day trading boomed with online brokerages like *Trade. Average investors quit jobs to trade full-time. Mergers peaked with AOL's $147 billion. Acquisition of Time Warner in January 2000, the largest ever, symbolizing new media triumphing over old. Amazon's stock rose from $1.50 split adjusted in 1997 to over $100 by 1999. Cisco became the world's most valuable company briefly. Yahoo, eBay, and Priceline soared on promises of disrupting industries. Even established tech like Intel, Oracle, and Microsoft benefited, but Pure.com's captured imaginations. Speculation reached extremes. Companies announced websites and stocks jumped 50%. Insiders sold billions while hyping shares. By early 2000, the NASDAQ's PE ratio hit 200, far above historical norms. Euphoria peaked. The internet was the new economy, immune to old rules. Endless growth seemed guaranteed. Beneath the surface, warning signs mounted as early as 1996. On December 5, 1996, Alan Greenspan famously asked, "How do we know when irrational exuberance has unduly escalated asset values?" Markets dipped briefly, but the rally resumed stronger. Y2K buildup drove tech spending in 1999, but January 1, 2000 passed quietly. Post-Y2K, spending slowed. Inflation ticked up. The Fed raised rates 6 times from June 1999 to May 2000, pushing the federal funds rate to 6.5%. Higher rates made borrowing costlier, squeezing cash-burning startups. A March 2000 Barron's article, Burning Up, analyzed 207 internet companies. Most had less than a year's cash left at current burn rates. Many .coms reported massive losses. Revenue growth couldn't keep pace with expenses. On April 3, 2000, antitrust ruling against Microsoft rattled tech sentiment. Insiders sold heavily. In the months before the peak, they dumped shares at record ratios. On March 10, 2000, the NASDAQ closed at 5,048.6 to its all-time high. The next day, selling began. Japan's recession news triggered global drops, hitting tech hardest. By March 20th, the index fell 10%. Whispers of overvaluation grew louder. As companies delayed earnings, citing accounting issues. Investor confidence wavered. The turning point arrived. Speculation met reality. Fundamentals reasserted themselves. The crash unfolded brutally and swiftly. From mid-March 2000, selling accelerated. On April 14th, the NASDAQ plunged 9% in one day, ending a week down 25%. Panic set in. Margin calls forced sales. Retail investors, late to the party, faced ruin. Higher rates dried up capital. Venture funding slowed. Earnings seasons exposed truths. Many .coms posted losses far worse than expected. Iconic failures mounted. Pets.com, the sock puppet star, went public in February 2000 at $11 per share. By November, it liquidated, stock worthless after burning $300 million. Webvan, promising 30-minute grocery delivery, raised billions and expanded aggressively. It built massive warehouses but couldn't attract enough customers. Bankruptcy in July 2001 after over $800 million spent. Boo.com, a flashy fashion site, burned $135 million in 18 months on celebrity parties and complex technology. Liquidated in May 2000. eToys soared to $8 billion valuation, but collapsed under competition and losses. Kozmo.com promised 1-hour delivery of anything, no fees. It raised $280 million, but shut down in April 2001. WorldCom and Global Crossing faced telecom overcapacity scandals. By October 2002, the NASDAQ bottomed at 1,114, a 78% drop from peak. Total losses, $5 trillion in market value erased. Thousands of startups folded. Venture funding fell 90% by 2001. Layoffs swept tech. Unemployment rose from 4% in 2002, 6.3% by 2003. The bust contributed to the 2001 recession, with GDP contracting briefly after 9/11's shocks. The dot-com bust reshaped the economy and tech landscape. The 2001 recession, though mild compared to later crises, lasted 8 months. Stock losses reduced consumer spending. Job cuts hit hardest in tech hubs like Silicon Valley. The Fed slashed rates to 1% by 2003, aiding recovery but sowing seeds for future bubbles. Winners survived by adapting. Amazon pivoted to efficiency, expanded beyond books, and emerged stronger. Its stock eventually soared. Google, founded in 1998, went public in 2004 and dominated search. eBay thrived in auctions. PayPal spun off and grew. Cisco and Qualcomm recovered slowly after 80 to 90% drops. Losers were countless. Retail investors lost retirement savings. Many dot-com millionaires went broke. Venture capitalists shifted to caution, demanding profitability paths. About 48% of dot-com firms survived in some form, but most diminished. The bust exposed hype dangers, flawed accounting, and speculative excess. Yet, it laid infrastructure. Broadband expanded. E-commerce matured. Survivors built Web 2.0 social media, cloud computing fueling today's giants. Causes low rates, abundant capital, media hype, and ignorance of fundamentals created speculation detached from reality. Effects: trillions lost, recession triggered, innovation temporarily stalled, but viable tech strengthened. Key lessons: bubbles arise when growth expectations outpace evidence. Valuation must tie to revenue and profits, not promises. Diversification guards against sector mania. Get big, fast fails without sustainable models. Regulators and investors must recognize exuberance early. True innovation endures scrutiny. Hype does not. The dot-com bubble was a spectacular frenzy of innovation and greed in internet. Gold rush that promised endless wealth but delivered devastating ruin, erasing trillions and humbling a generation of investors. Yet, from its ashes rose the modern digital world we know today. In the end, it teaches an eternal truth. Markets reward real value, but punish illusion without mercy.